The smell of a casino is distinct. It's a cocktail of oxygen pumped in to keep you awake, and the ozone tang of 1,000 slot machines burning electricity to calculate how best to ruin your life. But that's the old world. That's the analog world. In the year of our Lord 2026, the Dasians have migrated. They haven't stopped gambling. They've just upgraded their venue. They've left the sticky carpets of Vegas for the blue light glow of Kalshi, the decentralized Wild West of Polymarket, and the gamified sleekness of Robinhood. They aren't betting anymore. If you call it betting, a lawyer in a $3,000 suit will appear out of thin air and slap you with a cease and desist. They are trading event contracts. They are hedging against political risk. They are participating in a price discovery mechanism for information aggregation. It is the greatest linguistic magic trick since someone decided to rebrand the pyramid scheme as multi-level marketing. But here's the thing about magic tricks. They rely on you looking at the girl in the sequin dress, not the trapdoor under your feet. Behind the legalese and the slick user interfaces lies a machine. A cold, hard mathematical machine composed of central limit order books, automated market makers, optimistic oracles, and conditional token frameworks. And unlike a slot machine, which is a black box designed to extract value from your soul, these machines are open. Their guts are spilled across the blockchain or buried in filings with the Commodity Futures Trading Commission. Think of it like this. It's not proprietary closed software. It's built on principles like Linux, where everything is exposed for examination. I'm Mr. Pulte. I've rebuilt their algorithms, I've read the lawsuits, I've simulated the house edge until my GPU cried for mercy. And today we are going to tear apart the engines of the prediction market industrial complex. We're going to look at how Kalshi calculates its fees, how Polymarket's oracle can be hijacked, and how Robinhood is quietly building an empire on the back of your desire to bet on whether the Fed cuts rates or Taylor Swift releases a new album. Buckle up. It's going to be a long night. Let's start with the most obvious question, the one that everyone asks right before they lose their first $100. How is any of this legal? If I set up a folding table on a street corner in Manhattan and let people put $10 on whether it rains tomorrow, I go to jail. I get charged with running an illegal bookmaking operation. But if ForecastX does it, if Kalshi does it, it's a financial instrument. It's a triumph of American innovation. Why? Because of a very expensive dictionary in a federal agency called the Commodity Futures Trading Commission, CFTC. The entire existence of legal, regulated U.S. prediction markets hinges on a semantic war over the definition of the word gaming. Under the Commodity Exchange Act, CEA, the CFTC has the power to prohibit contracts that are contrary to the public interest. Specifically, they can ban contracts that involve terrorism, assassination, war, gaming. For years, the CFTC looked at election betting and said, that's gaming, it's gambling, it's betting on a horse race, but the horses are politicians and the track is the Electoral College. But Kalshi, founded by a couple of MIT whiz kids who probably calculate the probability of their toast landing butter side down, looked at that definition and said, objection. Their argument was a masterclass. They argued that gaming implies a game played for entertainment. A game involves participants playing against each other in a contest, like poker, or football, or Fortnite. What about an election? An election isn't a game. It is a serious economic event with massive financial consequences. Control of Congress determines tax rates, environmental regulations, and trade tariffs. Therefore, they argued, buying a contract that pays out if the Republicans take the Senate isn't gambling, it is hedging. Think about it. Imagine you own a solar panel company. If the Democrats win, subsidies flow and your stock goes up. If the Republicans win, subsidies might get cut and your business suffers. By buying a Republicans win contract on Kalshi, you are hedging your business risk. Scenario A, Republicans win. Your business takes a hit, but your Kalshi contract pays out, offsetting the loss. Scenario B, Democrats win. Your Kalshi contract goes to zero, but your business booms. It's insurance. It's risk management. It's sophisticated finance for the modern age. And guess what? The courts bought it. In the landmark case Kalshi EX LLC versus CFTC, the U.S. District Court for the District of Columbia ruled against the CFTC. The court essentially said that the CFTC couldn't just blanket ban election markets by calling them gaming without better justification. The judge ruled that an election is not a game in the statutory sense, and therefore, contracts based on elections do not automatically involve gaming. This ruling was the crack in the dam. It didn't just open the door, it blew the door off its hinges. It allowed Kalshi to list contracts on which party would control the House and Senate, explicitly framing them as hedging instruments rather than bets. But the victory wasn't absolute. To operate as a designated contract market, which is the regulatory gold standard that Kalshi and ForecastX hold, you still have to pass the economic purpose test. Every contract listed on a DCM must serve a valid economic function. Generally, this means it must be used for 1. Hedging, allowing market participants to transfer risk, like our solar panel guy. 2. Price discovery, revealing the true market probability of an event, which provides valuable information to the public. This is why you see contracts on things like Fed rate cuts or CPI data. These clearly have economic utility. Banks, hedge funds, and businesses need to hedge against interest rates and inflation. But where it gets murky and where the loophole expands is with the fun stuff. The Oscars, the Super Bowl, the weather. How does betting on the best picture winner serve an economic purpose? Kalshi argues movie studios need to hedge their marketing spend. If they win, they spend more on promotion. If they lose, they pivot. How does betting on the Super Bowl serve an economic purpose? Broadcasters need to hedge ad revenue. Bar owners need to hedge beer sales. It's the pizza is a vegetable logic applied to high finance. By framing every event as a source of financial risk for someone, they can argue that a market on that event allows for hedging that risk. While the Feds, CFTC, have been maneuvered into a corner by the courts, the states are not going down without a fight. State regulators in Nevada, New Jersey, and Connecticut look at a Kalshi contract that asks, will the Chiefs win the Super Bowl? And they don't see a sophisticated hedging instrument. They see a sports bet. And more importantly, they see a sports bet that isn't paying them taxes. In December 2025, Connecticut issued cease and desist orders to Kalshi, Robinhood, and Crypto.com, explicitly calling their operations unlicensed sports wagering. They argued that if it looks like a duck, a bet on a sports outcome, and quacks like a duck, pays out based on who wins, it's a duck. The Nevada Gaming Control Board took a similar stance. They don't care if you call it a derivative. In Vegas, betting on sports requires a gaming license. Kalshi sued, arguing that federal law preempts state gambling laws. Kalshi is betting the farm on the idea that because they are federally regulated by the CFTC, states literally cannot regulate them. If the CFTC says it's a swap, a state can't say it's a bet. So far, the results are mixed. Kalshi won preliminary injunctions in some states but faced setbacks in others. It is a messy, expensive legal war, and every time you place a trade, you are effectively funding their legal defense team. Then there is Polymarket. They didn't bother asking for permission. They didn't hire a lobbyist to buy lunch for a CFTC commissioner. They just wrote some Solidity code, deployed it to the Polygon blockchain, and said, code is law. The CFTC, predictably, did not agree. In January 2022, they slapped Polymarket with a $1.4 million fine and a cease and desist order for operating an illegal, unregistered facility. Polymarket's response? Okay, we'll block US users. They implemented a geofence. If your IP address was in the US, you couldn't trade. Did it work? Well, let's just say that VPN usage among crypto degens is roughly 100%. But legally, Polymarket could say, we aren't targeting US customers. If they climb the fence, that's on them. But here is the plot twist. Polymarket didn't die, it grew. It became the global standard for liquidity simply because it was permissionless and frictionless. And now they are initiating a Trojan horse re-entry into the US. How? By partnering with compliant entities. Polymarket recently received CFTC approval to allow US users access through regulated intermediaries. They are essentially saying, we aren't the casino, we are just the technology provider. We make the slot machines. If you want to play, talk to the guy with the license. This tech layer strategy is brilliant. It insulates them from custody risk. They don't hold your money, the smart contract does. And regulatory risk. The intermediary handles KYC/AML. And finally, enters Robinhood. The app that gamified investing is now gamifying, well, gaming. Robinhood watched Kalshi do the hard, expensive legal work of fighting the CFTC. They watched Polymarket prove the massive demand for these markets. And they said, we'll take that. Initially, Robinhood didn't build its own exchange. It built a front end. When you trade a prediction contract on Robinhood, you are, or were until recently, actually trading on Kalshi or ForecastX via an omnibus setup. But Robinhood got greedy, or smart. They realized prediction markets were their fastest growing revenue stream. So in late 2025, they announced a joint venture with market-making giant Susquehanna to launch their own futures exchange, acquiring MeXDX. Why rent the casino when you can buy the land? By owning the exchange and the clearinghouse, Robinhood can capture the entire economic stack. They don't have to split fees with Kalshi. They can internalize the market-making profits via Susquehanna. It is vertical integration of the gambling instinct. So is it rigged? Legally, no. It is a highly regulated financial product protected by federal preemption and intricate definitions of economic purpose. But structurally, the house is building a very, very big moat. Now that we know why these casinos are allowed to exist, let's look at how they actually take your money. You might think betting is simple. You say Trump wins, you put down $1, and if he wins, you get $2. But in the world of event contracts, nothing is simple. There are two competing religions in market design, the central limit order book and the automated market maker. Understanding the difference is the only way to know if you are getting a fair price or if you are getting fleeced by an algorithm. Kalshi uses a CLOB. This is exactly how the New York Stock Exchange works. It is the gold standard for institutional finance. How it works. The CLOB has three main parts. The first one is the order book. There is a list of people wanting to buy, called bids, and a list of people wanting to sell, called asks. The second one, the match. A trade only happens when a buyer meets a seller at a specific price. And the last one, the spread. This creates a gap. Maybe the highest someone will pay for yes is 60 cents. The lowest someone will sell yes for is 62 cents. That 2-cent gap is the bid-ask spread. No trade happens until someone crosses it. The math of the binary pair is simple. On Kalshi, every market is a pair of contracts that sum to $1. One contract is yes, and the other is no. If you buy yes at 60 cents, you are effectively taking the other side of someone who is buying no at 40 cents. Ignoring fees for a second. The exchange matches you. You pay 60 cents, the other guy pays 40 cents. The exchange holds the $1 in a clearinghouse. If yes wins, you get the $1. If no wins, he gets the $1. So now let's talk about the pros and cons of trading on a CLOB. Starting with the pros. The pros first, price certainty. You know exactly what price you are getting. You set a limit order at 60 cents, and it either fills at 60 cents or it doesn't. Second, capital efficiency. Market makers love CLOBs because they can place tight spreads without impermanent loss. We'll get to that. Now, the cons. First, liquidity cliffs. If there is no one on the other side, there is no trade. In a niche market, like will it rain in Austin? The order book might be empty. You sit there with your dollar, waiting for a counterparty who never comes. Second, The thin book. Retail traders often just want to bet now. In a CLOB, if you try to buy 10,000 contracts with a market order, you will chew through the order book, paying higher and higher prices as you consume the liquidity. This is called slippage, but in a CLOB, it's visible. You can see that there are only 50 contracts at 60 cents, and the next ones are at 65 cents. So how do you fix an empty order book where nobody wants to trade? Enter the AMM. Polymarket started with an automated market maker, AMM. This is pure DeFi magic, born from the loins of Uniswap. In an AMM, you don't wait for a counterparty. You trade against a liquidity pool. A robot stands there with a bag of yes tokens and a bag of no tokens, ready to trade with you at any time. The classic formula for an AMM is the constant product market maker, CPMM, where X equals quantity of yes tokens in the pool, Y equals quantity of no tokens in the pool, K equals the invariant, a constant number. How price is derived? The robot doesn't have an opinion on the election. It just wants to keep K constant. The price of yes is determined by the ratio of the reserves. Now the trade. Let's say the pool has 100 yes and 100 no. K equals 10,000. The price is 50-50. You want to buy yes. You put in money, the robot gives you yes tokens. Now the pool has fewer yes tokens, so X goes down. To keep X times Y equal to 10,000, the pool must have more no tokens. Y goes up. Effectively, your money buys no tokens that stay in the pool to balance it out. Since X is lower and Y is higher, the price of yes goes up. The more you buy, the more you shift the ratio. If you buy one yes token, the price moves a tiny bit. If you buy 50 yes tokens, half the pool, the price moves massively. You might pay an average of 75 cents, even if the start price was 50 cents. This curve creates slippage. The cost of your trade increases as you make it. Prediction markets often use a variant called the logarithmic market scoring rule, or a modified fixed product market maker. These are tweaked to handle the fact that the price must stay between 0 and 1. In Uniswap, a token price can go to infinity. In prediction markets, a probability cannot exceed 100%. The LMSR cost function looks terrifying, right? But don't worry about the calculus. Here is all you need to know. See that B? That's the liquidity parameter. Think of it as the depth of our pool. The deeper the pool, the less a trade moves the price. This math acts like a shock absorber and guarantees there is always a price without ever breaking 100%. But Polymarket hit a wall. Pure AMMs have a fatal flaw: capital inefficiency. To support a huge bet, you need a massively deep pool, a huge B. If the pool is small, the whale jumps in and creates a tidal wave of slippage. They get a terrible price, so they just don't trade. So, Polymarket pivoted. They threw out the pure AMM and brought back the Wall Street order book, creating a hybrid CLOB system. Here is the magic trick. Matching is done off-chain on a centralized server. It's lightning fast, like a traditional exchange, with zero gas fees, but settlement? That is done on-chain. The smart contract locks up the money so nobody can cheat. The result? You get the tight spreads of a CLOB with the transparency of the blockchain. It's the best of both worlds, assuming you trust the operator not to front-run you. Then there is ForecastX, the brainchild of interactive brokers. They looked at CLOBs and AMMs and said, too complicated, let's just be the bank. They operate on a no-sellers model. When you go to ForecastX, you don't see an ask price from another user, you just see a price. You place a bid for yes at 60 cents. Someone else places a bid for no at 41 cents. ForecastX holds these orders. They don't match them instantly. They wait until the math is perfect. Once they find a yes buyer at 60 cents and a no buyer at 41 cents, total $1.01, they execute the pair. They collect the $1.01. They stick the money in a vault. At resolution, they pay out $1 to the winner. They keep that 1 cent risk-free. This is genius. They literally cannot lose money on the outcome. They only execute trades when the participants have over-collateralized the event by exactly $0.01. It is the ultimate house move. They aren't gambling, they are toll collecting. We talk about buying shares on Polymarket, but that's a UI abstraction. What you are actually doing is interacting with one of the most sophisticated pieces of smart contract engineering in existence, the Gnosis Conditional Token Framework. The CTF doesn't just create tokens out of thin air. It enforces the law of total probability through two core functions: split position and merge positions. 1. The split minting probabilities. You cannot simply mint a yes token. That would create unbacked liability. To enter the market, you send collateral USDC to the CTF contract. The contract takes your 1 USDC and splits it into a complete set of outcome tokens. For a binary market, splits it into 1 yes token plus 1 no token. Why? Because mathematically, value yes plus value no equals 1 USDC. Regardless of who wins, one of those tokens will be worth $1 and the other $0. The sum is always $1. So the system is fully collateralized at all times. There is no fractional reserve banking here. 2. The merge. This is the inverse. If you hold 1 yes and 1 no token, you effectively hold a winning ticket. One of them must win. You can call merge positions to burn both tokens and unlock 1 USDC from the contract. Second, the arbitrage loop. This split/merge mechanic is what keeps the market prices efficient. Imagine the order book goes haywire. Price of yes equals 60 cents. Price of no equals 30 cents. Sum equals 90 cents. This is free money. A bot will instantly buy yes and no for 90 cents total. Call merge positions to turn them into 1 USDC. Profit $0.10 risk-free. Conversely, if prices are too high, greater than $1, a bot will send 1 USDC to split position, get 1 yes plus 1 no. Sell yes for 60 cents. Sell no for 50 cents. Total revenue, $1.10. Profit, 10 cents, risk-free. This hard-coded logic ensures that the market probabilities always sums approximately 100% minus fees. If you don't trust their front end, you can calculate the fair price yourself using Python. This script simulates the AMM logic, CPMM, to see how much slippage you should pay versus what they charge you. If you run this, you see the brutal reality of price impact. In the small pool, $1,000 reserves, a $100 bet moves the price significantly. You pay a huge premium slippage. In the large pool, $1 million reserves, the $100 bet barely moves the needle. This is why liquidity is king. A prediction market without deep pools is just a trap for retail traders. You enter at a bad price, and you can't exit without crashing the price against yourself. You can have the best smart contracts, the deepest liquidity, and the cleanest UI. But none of it matters if the person deciding the outcome is blind, bribed, or just plain stupid. This is the Oracle problem. You bet on did aliens land? Kalshi says no. Polymarket says maybe. The risk isn't just picking the wrong horse, it's picking the right horse. But the judge deciding the photo finish has money on the other guy. Kalshi resolves markets using a source agency. Will CPI be greater than 3%? Source, Bureau of Labor Statistics. Will Chiefs win? Source, NFL.com. This is clean, it's efficient, but it is centralized. If the BLS website crashes, or if the NFL changes a rule retroactively, Kalshi decides. On the other hand, Polymarket outsources truth to the UMA optimistic Oracle, a system vulnerable to manipulation. How it broke? A market on a Trump mineral deal with Ukraine. The factual outcome was clearly no. A whale and holding 25% of UMA tokens disputed the correct no outcome and then used their massive voting power to force a yes resolution. The Oracle reported yes, providing a false truth. Users betting on the correct no outcome lost everything. The attacker likely made significant profit by buying yes shares cheaply before rigging the vote, overriding any cost of token devaluation. This is the nightmare scenario. Proof of stake truth turns into proof of wallet. If the profit from rigging the market is greater than the cost of corrupting the Oracle will be corrupted. Robinhood adds another layer of risk. Since they act as an intermediary, Their terms of service allow them to void trades in case of exchange errors. Imagine betting on a horse, watching it win, and then the track says, "Sorry, the ticket machine was calibrated wrong. Here's your $2 back." You don't lose money, but you lose the win. This void risk is the hidden tax of using a gamified broker. You think you're trading against other users? Cute, you are. But you are also trading against the friction. Kalshi doesn't charge a simple flat fee. They charge based on expected earnings. The formula is a thing of beauty for them, where C equals count of contracts, P equals price, probability. The term P times 1 minus P is maximized when P equals 0.5. This means fees are highest when the outcome is uncertain, 50-50 odds. Fees are lowest when the outcome is obvious, 99-1 odds. Why? Because 50-50 markets have the highest volatility and volume. Polymarket claims no trading fees on their main platform, but you pay the spread. If yes is 60 cents and no is 42 cents, that missing 2 cents is the cost of liquidity. It goes to the liquidity provider. For their compliant US reentry, Polymarket is introducing a 0.01% taker fee. This is aggressively low, 10 cents on a $1,000 trade. ForecastX pays you interest on your position. This is unique. If you buy a contract for 50 cents and hold it for a month, you earn interest. Why do they do this? Because your cash is fully collateralizing the trade. You put up 50 cents. The no buyer puts up 50 cents. ForecastX holds $1. They invest that $1 in treasuries, earning approximately 5%. They pay you the interest. They keep the spread. Plus, they charge a 1 cent fee per contract execution. Since the contract pays out $1, a 1 cent fee is effectively a 1% fee on the notional value. If you look at Polymarket's volume, you'd think the whole world is betting on the election. Billions of dollars. But look closer. Rumors of a dollar Pili token airdrop turned Polymarket into a wash trading paradise in 2024. Traders engaged in Sybil attacks. Strategy A, buy yes and sell yes back and forth to generate volume. Strategy B, account A buys yes. Account B buys no. They hold, they redeem. They lose the fees spread, but they rack up volume points for the airdrop. Why it matters? If you use prediction market volume as a signal for market conviction, you are being fooled. High volume doesn't necessarily mean high certainty. It might just mean high farming activity. Enough talk. Let's do the math. I wrote a Python script to calculate your real expected value accounting for these fees and spreads. This is the calculator the casinos don't want you to have. If you run this, you'll see that fees eat your edge alive. At 55 cents price and 2 cents fee, your cost is 57 cents. If your true probability is 60%, your expected value is positive, $3. But if your true probability is 56%, you lose money. The fee moves your break-even probability from 55% to 57%. You need to be 2% smarter than the market just to break even. In a highly efficient market, finding a 2% edge is incredibly hard. The house edge turns a coin flip into a losing game. We are witnessing the financialization of truth. Kalshi, Polymarket, and Robinhood have built systems that turn opinions into asset classes. They have successfully argued that betting on the future isn't gambling, it's information discovery. They operate under federal derivatives laws to bypass state gambling prohibitions. The oracle is the single point of failure. If the oracle can be bought, the market isn't trustless, it's just trust shifted. The reality is that the house is extracting value at every step, via fees, spreads, and interest on your collateral. Is it rigged? Mathematically, usually no, except when the whales attack. Structurally, the odds are stacked by friction. But hey, at least it's not a slot machine. In a slot machine, you hope for 777. Here, you can scan the GitHub repo, audit the smart contract, run a Monte Carlo simulation. Welcome to the future. It's volatile, it's decentralized, and it's expensive. Mr. Pulte, signing off.